In this segment, we will discuss the difference between the ACRS and MACRS methods. The Accelerated Cost Recovery System is the basis for the current Modified Cost Recovery System that we use for tax purposes today. It's important to spend a few minutes talking about this since this is where the current system originates from. ACRS generally applied to tangible depreciable property placed in service after December 31st, 1980 and before January 31st, 1987. So while it's certainly less commonly seen in practice, you will still occasionally run across it. For the most part, you will only see it in situations where the property is being depreciated using ACRS if taxpayer elected an especially long optional straight-line recovery period under ACRS, or the taxpayer or related party previously owned the property in 1986, and the current ACRS deduction would be smaller than that of the maker's deduction. The main differences between ACRS and MACRS is that ACRS had a shorter recovery periods for almost all types of property, and it allowed real property to be depreciated using the declining balance method. As I mentioned a moment ago, MACRS is based on the original ACRS method with certain modifications. It's mandatory for most tangible depreciable property placed in service after 1986. Under MACRS, there are two depreciation systems, which we'll talk about in more detail in a few minutes. The first is the general depreciation system, and then the next is the alternative depreciation system. MACRS applies to most depreciable property placed in service today, and by depreciable, we're talking about property that is deemed to wear out. It has a determinable life that exceeds 1 year and is used in a trade or business. Assets depreciated under MACRS are reported in Part 3 of Form 4562. All current year additions are grouped by asset class and require disclosure of the depreciable basis, the recovery period, the convention, and the method. Depreciation for assets placed in service in a prior year is aggregated and reported as one number. There are really two depreciation systems under MACRS, the general depreciation system and the alternative depreciation system. So let's take a couple of minutes to talk about the differences between the two and when one is used over the other. The alternative depreciation system, or ADS, is mandatory for certain property. If you have tangible property that's used predominantly outside the U.S., and by predominantly we mean more than 50% outside of the U.S., or if you've got property that's tax-exempt property that's that was financed by tax-exempt bonds, or if you have property that's imported from a foreign country for which an executive order is in effect because the country maintains trade restrictions or is engaged in other discriminatory acts. ADS recovery periods are typically longer than those under GDS. For example, personal property with no class life is depreciated over 12 years under ADS versus the 5 to 7 years that would be depreciated under MACRS. Non-residential real property and residential rental property is depreciated over 40 years instead of the normal 39 or 27 and a half years. And then railroad grading or tunnel bores is depreciated over 50 years. GDS is generally used to compute depreciation under MACRS unless ADS is specifically required or if the taxpayer makes an election under Section 168 to use ADS. When the election is made to use ADS, it is made on a property class basis. So if you elect it for 7-year property, all 7-year property placed in service during that current year is going to be depreciated under ADS. Also, the ADS election, once made, is irrevocable. So why might you make an election? The most common situation is when you have expiring NOLs or credits that you need to use. So you may not want to front load your depreciation and risk losing your NOLs.